Joining me is one of Australia's best regarded value stock market investors, the founder of Investors Mutual, Anton Tagliaferro. Anton, many thanks for your time. You must be confounded by all this as a value investor.
It's pretty confusing. I mean, when you think about the volatility we've had and what's changed, I mean, and as you said, economic growth is not exactly booming, and profit growth isn't, that great. And what we're seeing is multiple expansion. Stocks are going up. If you look at, for example, CBA and Wesfarmers, the PEs just keep going up. CBA just reported their results recently. They're okay, up 1 or 2%, whatever. But the share prices are going up. Share prices of these companies are going up a lot faster than the earnings growth.
But we're having a look here. So I know there's recovery here, but the 1 month returns for the ASX 200, 5 2/3%. I mean, that's a big month, for goodness sakes.
It is. It's a recovery, I guess, from where we were. So people would say it's just coming back to where it was. But I guess the point is, it's being led, the index is being led by a few stocks, some of the larger stocks, where, as I said, the PE keeps getting larger and larger, which sort of drags the index up.
But did you, as a value investor, know profit has got to follow where the share price has gone? Well, the question is now, can you see over the next 6 months or so these companies coming out with stellar profits and justify these share prices?
No, it's not going to happen, Ross. But I guess the question is it's the momentum trade, it's money coming into the market, it's index trades, it's quant funds, so it's all that.
So let's back up and unpick that a little bit. An index fund, for example, if the Commonwealth Bank goes up, it's got to buy more Commonwealth Bank shares, which pushes Commonwealth Bank shares even higher, which then forces them to buy more shares. So in some ways, that kind of sounds like a bit of a Ponzi scheme in some ways. Is that the reality of what Australia's stock market has become?
In some of the larger stocks, yes. Although, as I said, it's not even across all the large stocks. I mean, if you look at the resource sector, BHP and Rio, they're still sort of floundering a little bit, right? Even though the iron ore price is quite high. So it seems to be very specific. So for example, CBA is the largest bank. It's probably the best run bank in Australia, and a lot of the money just keeps going into, one bank from overseas funds or whatever it is. Wesfarmers is the largest retailer in Australia. If people want to buy the largest retailer with, arguably the best retail operation in Bunnings, you just buy Wesfarmers. So there's that sort of stuff going on, I think, So.
But is that enough? I mean, we know in some ways, we've reported on this, that a lot of stocks have left the Australian stock market, that the companies are not attracted to the stock market because of the whole, sort of governance issues, because of the obligations to report to shareholders all the time. The question is whether our stock market is really doing investors the right thing right now.
Again, I don't want to generalise. I think there are pockets where valuations make no sense, and I've mentioned a couple of stocks there. But then if you look across the market, you'll find stocks which are more reasonably priced. I mean, again, if you look at Amcor, they've got a big acquisition coming on. Its earnings accretive. It's probably gone down the last month or two. Horizon, again, which I've mentioned before. Sure, there's bad weather in Queensland, which is affecting coal volumes, but they still own the rail track, whatever, for the next 100 years. So they're down, right? So it's not, even though the index is near an all-time high, it's not even across the board. Okay.
So then come back to one other aspect of it. Australia right now has got an unemployment rate of 4.1%. You've got a government that's got into power with an enormous mandate. We've talked about this morning already, but I just want to go to that because surely that was a good election to win. The economy is going to pick up. And if you've got lots of people in work, the question is whether the government is actually the one that's doing all the spending right now.
Well, yes, I think, record government expenditures are at a record percentage of GDP. And if you look at employment growth, a lot of it is coming from NDIS, healthcare, childcare, all those sectors. So, the government's spending more money, those services. So a lot of the employment growth is in those sectors. So I think, again, I've been trying to understand, because obviously if you look at the 10-year bonds, they've gone up. So that should be negative for the market. Yet, the US and Australia keep kind of going up. So I think basically you've got a situation where the fiscal tap is still open. Governments around the world are still spending. I mean, Donald Trump's just passed his wonderful tax bill, or whatever he calls it, by a majority of 1, where he's planning to increase the US deficit by another $4 trillion. There's another $4 trillion. European governments are still spending, cutting rates. Australia, obviously, we're cutting rates, and the government's still spending at a regular rate. So the world is pretty awash with money at the moment, right? And some of that is showing up in things like crypto, in gold, and in some of these stock prices.
Yeah, well, record levels for crypto this week with Bitcoin going to record levels. But then go back to those stock prices. I still go to this point that fundamentally you've got to have profits to back a share price.
Yeah.
Otherwise, that volatility does not go away. There is going to be significant volatility in the market in the future.
Well, there has to be a correction, yes, in those particular share prices. Again, I'm saying it's not even across every company, right? It's not every company on the ASX is overvalued, but there's a few instances of some of these larger stocks where, by any measure you look at, they look, hugely overvalued. Now.
And is this the problem of the chief executives and those running that company, or is that the problem of the judgment of the market and those index funds and those quant traders that end up having machines buying these things rather than human beings basically taking some control?
It's more the latter. It's more a technical type of issue where, there's obviously more buyers than sellers, which is pushing up share price up. And those buyers are not value buyers, they're probably quant funds or index funds who are pushing up the demand, and I guess people who've held CBA shares for many years, unless this unrealised tax comes in, they don't really want to sell. So, that excess demand over the supply just keeps pushing the share price up.
OK, I'll take you to that because I did want to talk to you about this. The government's plan to basically put this tax on unrealised capital gains with people with superannuation funds of more than $3 million.
Or $2 million, depends
or
on...
Or $2 million, depending on who it is. Is there any justification in your mind for it? I kind of get the sense that most investors, most people would say no. What's your own idea about this?
I think it's overly complex. I think it's not a very fair tax because every year you're going to have unrealised gains moving up and down. It's going to create a lot of complexity in terms of, at the moment, it's fairly straightforward to calculate your tax on your super. It's just going to put a huge amount of complexity. It's obviously going to cause people to have to sell assets if they don't have the cash because they're paying tax on an unrealised gain. So it's going to cause quite a bit of turmoil and confusion.
So tax and changes in tax always changes people's behaviour. What you're saying here is if that tax does come in, it will change behaviour and maybe mean that the pool of capital for new startups and new ventures is going to be less in the future.
Yes, that's potentially correct because obviously unlisted investments, if you have to pay tax on the unrealised gain in a private equity or venture capital fund, it doesn't make it very attractive because many of these funds you're locked in for 6 or 7 or 8 years. And if you have to pay tax on the unrealised gain, as I said, it just makes them not very attractive.
So the big issue here is about the unrealised gain. It's the fact that many people won't have the tax, rather the cash, to pay that tax.
Well, or they may have to sell other assets to pay the tax on gains, on unrealised gains, yes, on assets they hold in their portfolio. So if someone bought a property in their super fund for $200,000, it's worth $400,000 today. He doesn't want to sell it, but he's got to pay tax on that $200,000. Well, he's either got to sell a share or use his existing cash to pay that tax because he's not necessarily going to realise the property just to pay the tax.
So it's going to be fascinating to see exactly whether that does pass muster with the government. They seem determined. We'll find out. Anton Tagliaferro, always good to have you in the program. Many thanks for your time today.
Good to see you, Ross.